The thought of financing your first real estate investment property can be daunting. The complexity of loans, credit scores, and down payments often creates anxiety, making many potential investors hesitant to take the first step. In this video, we'll simplify the entire process, providing you with the knowledge and confidence to secure your first investment property and start building long-term wealth. Let's conquer those investment fears together and turn your dreams into reality. Welcome back to my channel. My name is Donnie Hathaway, where we help you build real wealth, long-term wealth, no quick gimmicks, just consistent work day after day to set you and your family up with generational wealth. So let's dive into what is a real estate investment. It's going to be the purchase, ownership, management, rental, and/or sale of real estate for a profit. So basically any real estate that you own that you are not actively living in the property for. So when it comes to financing your first real estate investment, we got to assess your financial situation. Let's talk about your credit score and financial health. Now, the importance of having a good credit score is going to affect your interest rates, how much you're paying in interest for your home mortgage. A higher credit score can secure the lowest interest rates. A lower credit score, you're going to be paying a little bit more when it comes to your interest rate. Also, having an improved credit score or a higher credit score is going to increase your chances of obtaining a loan approval. And without the loan approval, you're not going to be able to purchase a home. So maintaining a good quality credit score is going to allow you to make this first investment. And lastly, having a better credit score, a higher credit score, is going to give you better access to the terms and conditions of the mortgage itself. Less money out of pocket, access to different loan products are all going to be benefits of having a higher credit score. So if your credit score isn't where it should be, then let's talk about some tips to help you improve your credit score. Number one, and I think everybody is aware of this, but making timely payments. If you can set up auto payments for any of the bills that you have, then this is a great thing to do to make sure that you don't miss any of those due dates. Something else you could focus on is credit utilization, keeping your credit balances low. So if you have credit card debt, keeping those low. A rule of thumb is keeping them 30% or below of what your credit limit is. So paying those credit cards off monthly will be a good practice for you to improve your credit score. Something else you can do is debt management. So paying off any high interest loans that you have. So that would be things like your credit cards. If you have any home improvement loans, like maybe you took out a home improvement loan to make some improvements on your bathroom or plumbing or whatever it is, paying any of those high interest debts off that you have will help improve your credit score. And lastly, you should check your credit score monthly if you can, on a regular basis, just to see where you're at, to make sure that there's not any misinformation on your credit report. And if there is, taking action quickly to ensure that it doesn't hurt your credit score in the long run. Okay, next let's talk about budgeting and saving for your first investment property. Number one, you're going to want to determine how much you can afford. And usually we're going to do this by focusing on our monthly budget. How much of a monthly payment could we afford for this new investment? So to understand that, you need to do an income analysis. How much money are you bringing in on a monthly basis? This could be very simple if you just have one monthly income from your W-2 job. But if you have multiple sources of income, you're going to want to just calculate how much are you bringing in monthly. The next thing we're going to want to look at is expenses. How much are we spending every single month? Is there any room for improvements that we can make? What are our fixed costs, our fixed expenses, things like your mortgage, a car payment, that you have the same amount every single month? And then what of our flexible expenses, maybe like your entertainment costs or dining out costs? Can you make any adjustments to save and achieve your goal of investing in real estate? So once you have a good understanding of your budget, how much money is coming in, how much money is going out, then we can take a look at a mortgage calculator. You can find these online. These are simple tools that you can just enter in to determine how much a property is going to cost you on a monthly basis when you factor in principal and interest for the loan, taxes, insurance, and all the other costs associated with purchasing a property. Okay, so now that we have an understanding of how much that property is going to cost us on a monthly basis, how much is it going to cost for us to acquire this asset? So what are the down payments and loan costs associated with purchasing the property? Now there's a few different ways to go about determining how much money you want to put down on the property, but you could be anywhere from 3% down for your down payment all the way up to 20% down or more, right? There's no limit on how much you can put down, but if you're putting a low amount down, that's going to increase your monthly mortgage payment, which may make it difficult to generate that monthly rental income from your investment property. Typically, a rule of thumb, a better idea for an investment property is to put down at least 20% down. You're also going to avoid the PMI payment, principal mortgage interest payment, if you put 20% down or more, which will increase your rental income, obviously. Now, other costs that are associated with obtaining financing are any of the loan origination costs. So typically these range anywhere from 3 to 4% of the purchase price of the property. Okay, so now that we've assessed your financial situation and talked about some of the basics of obtaining a mortgage, let's talk about some of the different financing options. For this video, it's important to know that there are multiple different options to obtain financing for your investment property. So if you are a first-time home buyer, you have different options, low down payment options, anywhere from 3 to 3.5%. That's either a conventional loan or FHA loan for your down payment there. If this is not your primary residence, or it's strictly going to be an investment property for you, or it's not your first time buying a property, then your down payment options are going to range from 10% down to greater than 20% down, depending on the loan product and where you're buying the property. Other types of loans, there are investment loans, something called a DSCR loan, a debt service credit ratio loan. So basically they're approving the mortgage based on the amount of the mortgage payment compared to the average rent for a property in that particular area. Other options are hard money financing. Typically that's going to be a higher interest rate on those type of loans, but something like this could be good for if you're going to fix and flip a property where you're willing to pay that higher interest for a short period of time to get that line of credit. And lastly, this is where things can get super creative here, and that's seller financing. There really is no limit as to what the terms and conditions of seller financing can be. It's just what you're able to work out with the seller and their current financial situation. So if you are going the traditional route and applying for a mortgage, there's going to be some documentation that is needed to get your loan approval. So things like your personal identification, they'll need a copy of your government ID or driver's license if you have one. They'll need proof of income. So if you're a W-2 employee, any tax returns that you have usually the last 2 years, bank statements, and any additional income that you might have, you'll need to provide proof of that income. Employment verification is another thing that they're going to want to verify. And they're also going to want to take a look at your credit report. So your lenders will pull your credit. And they're also going to want to look at any assets or debts you might have. So bank statements are going to look at any checking or savings accounts that you have, any investment accounts, and then any debt. So any credit card debt that you might have, they're going to want to take a look at all of that information. And they'll also verify, when they're looking at your bank statements, verify that you do have the proof of funds, the funds available to make the down payments and pay for the property itself. So that's an overview of all of the documents that are going to be needed to get that pre-approval letter, which allows you to go out and make offers on properties. It's important that you have the pre-approval letter, that you've at least met with the lender, had conversations with the lender, and they provide you with the pre-approval. Because if you are shopping for homes, evaluating properties to purchase, and you don't have that pre-approval, you don't really technically know what you can afford, know what you can purchase. And a seller is not going to accept an offer without proof of income or that pre-approval letter if you're applying for a mortgage. So it's extremely important that you do this before you start evaluating properties and making offers on properties to purchase. I just gave you a great overview of everything you need to know about financing your first investment property. And that's why I've created an entire series that dives deeper into each one of these topics. Click the video that is on the screen now, and let's start your investment journey.